Chapter 4 is actually, so we're going to start talking about chapter 4, which are policy provisions, policy riders, and beneficiaries. So we're going to talk about those three things in this segment. Now, we're going to get as much as we can done. I know you have a quiz that you want the answers to, I'm sure. We'll do that this afternoon. The annuity section is like, I only take like 45 minutes to an hour to cover. So we've got some cushion time, and that's built into the class in case we don't cover everything we need to cover in the previous sessions. So, but I do want to start in on chapter 4 because chapter 4 makes up about 25 to 35 questions on your exam. So that's a pretty significant amount of your test, right? And the other thing I want to highlight in respects to that is that it's all definition. It's all definition. So again, so chapter 4, right, is policy provisions, policy riders, and beneficiaries. And it's mostly definition, if not all of it is definition. And so, one of the phrases I want to remind you that you'll hear over and over again from me is going to be, or is, words mean what they say. Words mean what they say. And so when we talk about these different definitions and policy provisions, we've got to cover them because policy provisions, these are basically the terms to the contract. So if we go back into an earlier chapter that we don't cover in the online training, the insurance policy, according to the California Department of Insurance, right? So the insurance policy is defined according to section 22 of the California Insurance Code. The insurance policy is defined as a contract. It's a contract. Oops, okay. Back here. As a contract whereby one undertakes to indemnify another against a contingent or unknown event. Now, this definition is worth 2 to 3 points on your exam, just knowing this one definition, which is obviously really important, right? Because you're getting your license to sell insurance. So you definitely need to know what is the definition of an insurance policy, right? So the insurance policy, again, is defined as a contract. Let me use a different color here. As a contract whereby one undertakes to indemnify another against a contingent or unknown event. And so because it's a contract, it is subject to contract law. Because it's a contract, it's subject to contract law. And I'm going to go ahead and cover these things that we missed. I'm going to take advantage of the fact that we are talking about the insurance policy. Because it's subject to contract law, in order to have a valid contract, and this is true for any contract, it's not exclusive to insurance contracts. In order to have a valid contract, there are 4 elements that must exist. There's actually 6, but for the purpose of the exam, there are 4 elements to a contract. 4 elements. Can anyone tell me what are those 4 elements of a contract? 4 elements.
Consideration.
Right, consideration, thank you.
Agreement.
Agreement.
Competent parties.
Agreement, competent parties. Competent.
Legal purposes.
Yes, competent parties and then legal purpose. Good job. Now, I say clickety-clack 4 elements of a contract. So clickety-clack 4 elements of a contract. So we've got the consideration here. You guys get them, set them faster than I can write them. Legal purpose, agreement, and then competent parties. And I put them in that order because it makes it easier to remember, right? Now, there are also 4 parts to the insurance policy. And I like to put these side by side because the 4 parts to the insurance policy are different than the 4 elements of a contract. And so the 4 parts to an insurance policy, we use an acronym, another acronym to help you remember, right? Can anyone guess what that acronym is? The picture doesn't tell you?
Dice.
Yes, thank you. So the four parts to, now notice contract law, right? Four elements of a contract. These are the four parts of the insurance policy, four parts to the policy. And yes, it is DICE. So the first part is the when we use this acronym to help you remember, it's the declaration page. We usually use that term for property and casualty. So it makes it much easier to remember DICE than PICE. So you have the declaration page, also known as the policy face, right? Which is really the first policy face, which is the first page of the policy, the first page of the contract. And what do you think you'll find on the first page of the policy? What will you find on the first page of the contract?
Your client's information?
Yeah, maybe not like all the information. Usually in the policy face, you'll have like the person who's being protected. It's like the summary page, right? The declaration page is like the summary page. It tells you who's covered for how much, for how long, what type of policy is it, who's the insurance company, who is the named insured. So it doesn't go into like necessarily putting in the address and the phone number or the personal information of that kind of nature, but it may say like male or female, that they're being rated at this age. So again, it'll tell you that it's like a summary of the terms of the contract. Who's covered, who's for how much, for how long, what's the premium, how long are they paying the premium, who's the insurance company, things of that nature. So I like to say it's the who, what, where, and when of the policy. That's the declaration page. It's just enough information to know what's going to be included. Then you also have what's called the insuring clause, and the insuring clause is found on the deck page. And the insuring clause is basically, it's the promise to pay. What is it?
Promise to pay.
Thank you. It's the promise to pay. And, and promise to pay. Who's paying? The promise by the
Insured.
Insurer?
insurer, exactly. The promise to pay by the insurer. Because if you remember back on Wednesday, it's an exchange of we talked about the premium, which is an act in exchange for the promise. And so that's what makes this contract actually called a unilateral contract, right? A unilateral contract is a one-sided contract. It's where there is an exchange of an act for a promise. And so the insured is performing the act by paying the premium, and then the insurer is making the promise. And it's also, I want to highlight this too, because this is something you may see on your exam. And a unilateral contract, only one party is obligated. So obligation is dependent on the other. So for example, if the policy owner doesn't pay the premium, so if the policy owner fails to pay their premium, if they don't pay to the insurance company, what happens to the policy?
Cancel.
Terminate? Cancel?
Yeah, the policy lapses, right? There's a policy lapse, the policy cancels. And what happens to the insurance company's promise? Do they have to, they don't have to pay, they don't have to fulfill on their promise if the insured fails to pay the premium. Because remember, obligation is dependent on the other. So if you don't pay your premium, then the insurance company is not obligated to fulfill on their promise. Does that make sense?
Mhm.
Now, if you pay your premium though, guess what? The insurance company is now on the hook. They have to fulfill on their promise as long as it's a valid claim. Well, how do we know it's a valid claim? How do we know that it's time to even file a claim? Well, you've got to look at the terms of the contract, because everything goes back to the terms and the policy provisions found in the contract. If you ever want to know what's covered, what's not covered, just read your policy. Your policy will outline that, right? And getting back to the four parts, this insuring clause, this promise to pay, is generally found on the deck page. And in a life insurance policy, the statement goes something like this: in consideration or in exchange of, and then they're going to have the premium, upon the death of the insured, they're going to name the insured, then the insurer, and it'll state promises to pay the total sum in the amount of, and then it'll spell out what the face amount of the policy is. So again, we've got the deck page, declaration page, who, what, and where, and when of the policy. You've got the insuring clause, which is the promise to pay found on the deck page. And then here's the most important part, I think, and that's the conditions. These are basically the terms of the contract. And we're going to talk about the conditions. Those are part of the policy provisions, or part of the policy provisions, pardon me. So we've got the conditions, which are basically the terms. And a condition for a life insurance policy is, in order for the policy to pay, what has to happen? In order for the life insurance policy to pay, what has to happen?
They have to
Die.
Thank
sign
you.
it. Sign-
Jalen, you just unmuted yourself long enough to say die, and then you muted yourself right back.
Sorry. I
No,
have a lot
no,
of people here right now.
no, it's okay. It was just amusing the way that it came out. No, I'm a very firm believer you have to have fun. If you're not having fun, don't do it. And if you have to do it, then get it done really quickly. And so I find the humor in like the little smallest things. And I just thought that was, if you go back and you listen to the video, you'll hear yourself die. So again, getting back to the deck page, the insuring clause, conditions, those are the terms of the contract. And yes, in a life insurance policy, someone has to die, right? So we need a death certificate. That's part of the terms. The other thing is like if you have a permanent policy, we talked about whole life as a permanent policy. Yeah, do you have a question, Celia?
No, I was sneezing, sorry.
Oh, that's okay. Bless you. If you have, sorry, my niece just called me and I got distracted by it. Let me turn this thing off. She'll call my mom. If we have, what was I just saying? Oh, the insuring, the death certificate, right? And then the terms of the contract. So, a permanent policy. So if you have a permanent policy has what inside of it? What's one of the benefits of having a permanent policy that you do not get with term insurance? Term has what? No. Term has what? No. I mean, if you don't know this, I will not give you well, no, you're already getting a certificate online, but I will not claim you as a student. Term has what? Term has no cash value. Term has like, that's got to come right out of you as soon as I say term has no what? No cash value. Term is temporary, right? It's just pure protection. So when you buy term insurance, all you're doing is buying pure protection. When you buy a permanent policy, one of the benefits of that contract is that it includes cash value. So the terms of taking a loan against the cash value and whether or not you have to pay it and what the interest rate may be when you take a loan against the cash value are all outlined in the policy loan provision of the contract. If you want to know if you can take money out ahead of time, like an accelerated death benefit, that provision would be found, it's actually a rider, and it would be found inside of the life insurance contract. Again, this is what makes this chapter so important because it is the terms of the agreement between the insurer and the policy owner, right? There's a contractual obligation there between the two parties. But what makes it unique, not only is it a contract of adhesion, it's an aleatory contract, which we talked about on Wednesday, but it's also a unilateral contract. So if I don't pay my premium, like I said before, then the insurance company is resolved or relieved of any liability of having to pay a claim. All of that is outlined inside of the contract. That is part of the terms. Now, can I be late for my premium? Is it okay to be late for my premium? I mean, it's better not to be late, but is it okay to be late on my premium? And what allows me to be late on my premium? Is it just because it's common business practice? It's because it's part of the terms of the contract. It's part of the agreement. So one of the provisions we'll talk about in a little bit is the grace period, right? The grace period is the time after the due date. Now, the only reason you have a grace period though, and the time outlined for the grace period is because it's outlined in the contract. So the policy, and I just want to reinforce this, that the policy is subject to contract law. So you always go back to the contract. You always go back to read the terms to see, okay, what can and cannot do, right? Now, the last part of the policy are the exclusions. And what do you think what are the exclusions? What does that mean? What does that mean, the exclusions?
What the policy's not going to cover?
Yeah, what yes, what the company won't do, right? What they will not cover. Well, and this is, and I know you're probably aware of this, Stephanie, because of the P&C products, right? They have lots of exclusions.
Mhm.
Not cover. In life insurance, we don't have too many exclusions. I like to say you die, we pay. It might be a little contrite, but that's usually what it is. Some common exclusions though that you might find include, and we have an acronym to help you remember the common policy exclusions, and that is WASH. wash. But there's not too many, right? I mean, 4 is pretty easy. So the first one is war. We've heard this before, especially after 9/11. Like, was it an act of war? Are the life insurance policies going to pay? Well, so war, you got to read the provision to find out the specifics about it. But usually if if there's war, or if somebody dies in uniform and it's a private policy, not written by it's not insurance through the government, then it might be an exclusion, or they might have a limited clause to it and pay up to a certain amount. So war is a common exclusion, right? War. What it is a good for? Absolutely nothing, huh, right? And then we have aviation. Some companies have aviation limitations and restrictions. What does that mean, aviation? Why would they put a limitation on aviation?
That's a risk.
Oh my God, it's a higher risk, right?
Yeah. That they,
Yeah. Now, it's not for, this is not like a commercial flight, regularly scheduled flight. We're not talking about that. We're talking about a private passenger airplane that, somebody charters a small plane to fly to Vegas. I know a few years ago, I used to be a regular at this wine bar in downtown San Jose. And I was going there and I did some sort of wine and painting thing. And I connected with the people around me. And the woman next to me says, "Oh my God, you're so funny, so fun to hang out with. I got to know when you come." I used to go on Wednesday nights. I was regularly there on Wednesday nights. And she says, "Oh, I got to come on a Wednesday night." A month goes by and I was talking to the owners behind the counter. I said, "Hey, you know that one woman that I was chatting with at the painting thing? What happened to her?" And she just almost broke down into tears. And she shared that her and her husband and the kids had chartered a plane to go to Vegas, and the plane went down and they all died. The family died together. And I'm like, "Oh my God, like, wow." And I share that because we hear about all these celebrities dying and it doesn't seem like too many, but it's not just like these big celebrities, but it's a common occurrence, not too common, but it's common enough to be a higher risk with a private passenger airplane, right? So you will find aviation limitations and restrictions. Now, at the same time, there's been some advances in aviation. And so again, that's where the limitation comes in. So some companies may exclude it altogether, or some companies might have limitations, but it just depends. That's why you've always got to go back and read the terms of the contract, right? And then this one we talked about on Wednesday as well, and that's the suicide exclusion. But it's only excluded for a limited period of time. And how long is it excluded for?
2 years.
2 years. Thank you. So you get 2 years and a day to think about. I'm just kidding. We don't want people doing that, but go for 2 years and a day. After that, the company will pay. Anything less than that, if the insurance death is a result of suicide before the 2-year mark from the date that they buy the policy, or the policy is issued, you got to read the policy to find out, right? They can exclude a claim. And what they'll do is that they'll void the contract, act as if it never existed, and then they'll return the premium. So you want to be careful of that. If they ask you, what will the company pay if the insured's death is a result of suicide within certain time limits? So they might not even say 2 years. They might say within certain time limits. Oftentimes that gets into the test taker's head and they're like, what are they talking about? They're just talking about the 2 years. But it depends on the contract. I've actually had students bring me these contracts where, we go over them together and I'll read, "Oh, look, there's a 6-month suicide exclusion." Or like, "Oh, look, there's a 1-year suicide exclusion." So it may be smaller, it may be less than the 2 years, but usually what I find is if it's less than 2 years, it's a lower risk to the company, meaning that it might be a term, it may be less than $50,000, usually like 20,000, like a final illness type of expense type of plan. So again, you always want to read the policy. I can't emphasize that enough. And then the last one is H, which is hazardous avocations and hobbies. What's an avocation? It's a hobby, right? Avocation's a hobby. I'm going to teach you something about language here. If you see the root word A usually behind another word means not. It's not. So it's not a vocation because vocation is job. So it's not a job, which would be a hobby. So hazardous equals, or hazardous avocations, and even hazardous jobs might be excluded. But again, you have to read the contract, right? So these are the common exclusions found in life insurance. We'll talk about the exclusions for accident and health insurance next week. All right, how are we doing so far? Any questions?
Nope.
Okay, so just to go back and review the insurance policy, because like I said, this is worth 2 to 3 points on your exam, just knowing this, because they'll ask you, according to the California Insurance Code, the insurance policy is considered a contract, right? That would be the answer. The other one would be a contract is considered, they'll like do it reverse where the answer is the question and the question is the answer. So a contract, which of the following may be considered a contract? And then you're going to find the answer of insurance policy. Then to highlight it a little bit more, they're going to ask you about indemnity. And you already know they're going to ask just indemnity alone will be 2 or 3 questions because that's what the insurance policy is all about, right? So what does it mean to indemnify? This is a good review for Monday. What does it mean to indemnify or Wednesday?
Make whole again.
To make whole. And I'm really glad you said that, Stephanie, because I still like to go back to the more expansive definition, right? To restore to the condition enjoyed prior to loss in whole or in part. The definition that Stephanie just shared is to make whole. You know, I don't actually emphasize that enough, but that is the answer to one of the questions. To make whole, because that is the purpose of insurance, is to restore, to bring you back to where you were before. The reason why I don't like to make whole though is because you're only going to get coverage for what you buy. You know, if you only buy minimum coverage, like, you know, if you buy what's the minimum financial responsibility for auto insurance? You don't need to know this for your life insurance exam, but it's 15, 30, and 5. They really need to increase that. But I live in San Jose. Do you know what they like to drive down here? What cars do they like to drive down to San Jose? Anybody know?
Teslas.
What'd you say?
Teslas.
Yes. Now, if I was driving around with 15, 30, and 5, thank you, Celia. If I was driving around 15, oh, sorry.
I'll take that credit. It's Stephanie.
Thank you, Stephanie. If I didn't have, I lost my train of thought. If I was driving around with this type of coverage, with this minimum amount of coverage, and I hit a Tesla, oh my goodness, I would be in trouble. Because do you think that if I hit a Tesla, it's only going to be $5,000 worth of damage?
Mm-mm.
No way. It's going to be way more than that. But yet again, people drive around, they think that, oh, I have coverage. Well, up to how much? Because there's limitations and people have to be aware of that. They've got to understand insurance a little bit more because it is meant to make whole. And you're only going to get coverage for the limitations for what you buy, according to the terms going back to the contract. All right, I'm going to start a new slide here. And I'm also going to pause the recording for a moment. So let me go back to, let's do this. Do that. Oh, here we go. So we'll do that. And then, let's see, stop here. Just give me, I'm going to get a little bit better versed at this. Okay, so stop. It's not stopping. Okay, there we go. It still didn't stop.